In 2008, people didn't lose their homes because they were irresponsible. Most of them were doing exactly what they were told was smart: buy property, build equity. It always goes up. That was the widespread belief, and almost every financial institution reinforced it. What followed was the worst economic collapse since the Great Depression. Not because of one bad decision, but because of a system quietly built to fail. To understand it, you need to start somewhere most explanations skip. Not Wall Street, not the banks. The house on a regular street. Someone working a decent job, maybe 2 incomes in the household. They qualify for a mortgage in 2004, 2005, somewhere in that window. The monthly payment looks manageable, at least for the first 2 years. What they weren't always told clearly: the rate wasn't fixed. It was adjustable. It would reset. And when it did, the payment jumped. These were called subprime mortgages, and they were being handed out at scale. Subprime means the borrower has a weaker credit profile, higher risk to the lender. Normally, that means stricter terms, higher scrutiny, or outright denial. But in this period, the scrutiny largely disappeared. Income verification got loose. Down payments shrank. Approvals moved fast. Some loans were being issued with almost no documentation required. The industry had a phrase for them: ninja loans. No income, no job, no assets. Approved. That sounds absurd now. At the time, it was volume business. The question is why? Why would a lender approve someone who clearly can't repay? Because the lender wasn't planning to hold that loan. They were going to sell it, almost immediately. This is where the mechanism gets interesting, and where most people's understanding stops. Banks and mortgage companies would bundle hundreds of these loans together, package them into a financial product called a mortgage-backed security, then sell that product to investors, pension funds, hedge funds, banks overseas. The investor buys the bundle and earns income from the mortgage payments coming in. On paper, it looks like a solid investment: real assets, real property, real payments. The problem was buried in the structure of the bundle itself. Rating agencies were assigning top-tier safety ratings to products full of shaky loans. AAA, the highest possible grade. Same rating as government bonds. Investors trusted those ratings. Most didn't have the time or tools to look deeper. And the agencies rating them were being paid by the same institutions issuing them. That conflict of interest didn't get enough attention until it was far too late. So you have a chain: borrower, lender, bundler, rater, investor. At every link, someone was earning fees. At almost no link was anyone holding the risk. The risk had been sliced, repackaged, and distributed so widely it became invisible. There was also a second layer built on top of all this: financial instruments called CDOs, collateralized debt obligations, essentially bundles of bundles, securities made from other securities. The complexity was so thick that even experienced analysts struggled to price them accurately. Some people on Wall Street understood the exposure. A few even bet against it. They quietly took positions expecting the whole thing to collapse. Most people involved, from loan officers to pension managers, were not asking hard questions. The system was generating fees at every stage, and fees tend to quiet concern. By 2006, roughly 1 in 5 mortgages being issued was subprime. Home prices had been rising steadily for years. That rise was baked into every assumption. If a borrower defaulted, the bank could foreclose, sell the house, and recover the loan. That logic held as long as prices kept rising. The moment they didn't, everything reversed. In 2006 and into 2007, home prices started softening in certain markets. Then the adjustable rates reset. Monthly payments climbed by hundreds of dollars. People who had been managing started missing payments. Defaults rose. Then foreclosures. Then the value of the mortgage-backed security started dropping. Investors who thought they held safe assets were suddenly holding something worth far less. The institutions holding the most exposure started showing stress on their balance sheets. Bear Stearns collapsed in March 2008, absorbed by another bank over a weekend. That was a warning. It didn't fully register as one. By September, Lehman Brothers filed for bankruptcy, one of the largest in American history. No bailout came for Lehman. The decision sent a shockwave through global markets. Credit markets froze almost immediately. Banks stopped lending to each other, not because they lacked money on paper, but because nobody trusted the numbers anymore. Every institution was wondering what the other one was actually holding. That uncertainty is more dangerous than a known loss. A known loss you can price. Uncertainty shuts the system down. AIG, one of the world's largest insurers, had sold protection on trillions in these securities. When the securities fell apart, AIG couldn't cover what it owed. The US government stepped in with a bailout exceeding $180 billion, not to save AIG, to prevent a chain reaction that would have hit everything connected to it. The stock market dropped roughly 50% from peak to trough. Retirement accounts that people had been building for decades lost enormous value. People in their late 50s, close to retirement, suddenly had far less than they expected. That is not abstract. That is someone recalculating their entire timeline at the worst moment. Unemployment rose sharply. By 2009, it was above 10% in the United States. Construction stopped. Consumer spending contracted. Small businesses closed. The ripple went far beyond people who had taken bad mortgages. Someone renting an apartment, never touched a mortgage, still lost their job. That is how systemic risk works. You don't have to be directly involved to absorb the damage. Governments and central banks responded with emergency measures. Interest rates were cut to near zero. Stimulus packages were passed. The Federal Reserve bought up mortgage-backed securities to stabilize the market. These interventions stabilized the collapse, but recovery was slow and uneven. Many households that lost homes never fully rebuilt their financial position. The banks that caused significant damage were largely stabilized and continued operating. That contrast didn't go unnoticed. It shaped a decade of public distrust in financial institutions. Now, what most people miss when they look back at 2008, it wasn't a few greedy individuals who broke an otherwise sound system. The incentives inside the system made this behavior rational at each individual step. The loan officer earned a commission on volume. Approve more, earn more. The bundler earned fees on every security created. More product, more fees. The rating agency earned revenue from the issuers. Tough ratings risked losing clients. The investor trusted the rating because due diligence on complex instruments is genuinely hard. Nobody in the chain needed the loan to perform. They needed it to close. That misalignment between who creates risk and who absorbs it is the core problem. It didn't start in 2008. It was built steadily over years of deregulation and incentive drift. The practical understanding to take from this isn't paranoia about banks. It's awareness of how financial complexity can obscure risk, rather than distribute it safely. When a financial product is difficult to explain clearly, that difficulty is worth noting. Not every complex instrument is dangerous, but complexity can hide things that plain language would expose. If you're ever looking at a financial product, mortgage, investment, insurance structure, ask who holds the risk if this goes wrong. Ask if the answer is actually you. That question alone cuts through a significant amount of financial marketing. The 2008 crisis didn't happen because people were stupid. It happened because a system was structured so that nobody had to care about the outcome. Understanding that distinction matters because the incentive problem doesn't disappear. It moves to different products, different markets, different language. The specific assets were mortgages that time. The underlying pattern is older and more portable. Ask yourself, in any financial decision you're making or being sold right now, who actually absorbs the loss if this doesn't work out the way it's described?